The path for bonds is probably a bit easier than equities, partly because look, we've had a 2022 as a record sort of year in terms of the bond market sell-off, especially in terms of this stagflationary environment. We haven't seen anything like this for sort of a good part of 4 or 5 decades. So, the risk of that repeating itself is probably low, and I think we're either going to straddle a really big downturn, I think, in this recessionary environment more than what the consensus is speaking about, or we get this Goldilocks environment where maybe the Fed pivots, but equally, the inflation data comes off quite quickly, but the labor market shows just enough pain to keep the Fed at bay. So either way, whether it's the Fed pivot or whether it's this recessionary environment, you kind of want to be owning bonds to some extent. It's just a case of how quickly bond yields come off. And obviously in the latter scenario, the sort of downturn crisis scenario, you could see some sharper haven flows coming through. So that's one of the no-brainer trades I like. And then on the back of that, you've got a range of cross-asset no-brainer trades, things like gold and also yen to some extent. These have been highly correlated to US yields, obviously, over the past 12 months. And equally, they've both had really bad years. I think, to some extent, and especially yen, we're talking about the yen a lot more now when you've also got the sort of positive tailwind potentially coming through from the Bank of Japanese cyclicality coming through at the time where the rest of the world seems to be slowing down. That goes into the no-brainer category for sure. I think this year could be the year of the yen.
Viraj, the year of the yen, we had a guest on Street Signs last week who said that is perhaps the most consensual trade of 2023. What is your response to that? Because it feels as though the majority of guests do believe in long yen, but to me that suggests that it is consensus, which doesn't necessarily bode well from here.
Yeah, look, I have some sympathy to that view. We've been sort of calling for that yen view for 4 months, maybe a month too early, but definitely on the side when we're talking about Bank of Japan intervention that we could easily get down to sort of the 120 level. My pushback to that is two things. One, that in this environment, I don't know an asset out there outside of commodities that is more momentum driven than dollar yen. It's almost like betting on sort of economic cycles on steroids. So to some extent, I've grown up with this adage that, when the yen moves, it moves big. And I think that you don't want to fight that, especially when you've got these such clear tailwinds coming through. So I have sympathy to the view that on the short-term basis, yes, it's a crowded view, it's consensus, but positioning just does not support that. If you were to see positioning in line with where the yen gets to on the eve of a recession, you've got a lot more room for these yen balls to move. And like I said, when the yen moves, it moves big. I wouldn't rule out on the eve of a recession something like dollar yen trading with a 110, if not a 105 handle. So look, I'm not saying that that's the path straight away. I think we'll get there in a series of sort of ups and downs. But, the trajectory is set for this year. And I think you want to be sort of riding that wave. And like I said, it's almost a no-brainer right now.